Micron just practically tripled its profit in a single quarter, and they did it without really shipping that many more chips. It is all because AI is basically begging for memory at literally any price.
Exactly.
So, it is March 18th, 2026, and we are unpacking Q2 results for Micron Technology, ticker MU. And the numbers are just staggering. Revenue came in at $23.86 billion. That is up 75% sequentially from T1. EPS was $12.20, completely crushing the $4.78 they posted last quarter. I mean, Miro, what kind of a hardware company operates like this?
Almost none. Look, you see an operating income of $16.45 billion, which is a 69% operating margin, and your first instinct is that it's a typo. They build physical memory chips, DRAM and NAND flash. This is heavy concrete and silicon manufacturing. And yet their gross margin just swelled to almost 75%. That is software territory.
Right, which is wild to think about. And just as a quick reminder to everyone listening, this is all just our personal opinion and absolutely not financial advice. But honestly, if memory is suddenly this expensive just to build out servers, aren't the normal companies, the ones making laptops and phones, aren't they just getting completely squeezed out?
Yes. They absolutely are. That is the underlying story here. Volume growth was actually tiny. I mean, their DRAM shipments only rose in the mid-single digits, but the prices they charged spiked in the mid-60s% range sequentially. NAND prices erupted by almost 80%. So if you're building PCs or smartphones, you literally cannot get enough memory, or it just costs a fortune. Data center NAND revenue more than doubled. So AI is essentially starving the rest of the consumer hardware market.
That makes total sense. But then help me understand the market reaction. Because the stock had this massive run up over 82% just this past quarter alone, hovering around the mid-460s. But right after they dropped these historic numbers, the stock just violently sold off. It dropped over 5% after hours, down to around 441. What did Wall Street hate?
They do not hate it. They're just terrified of gravity.
Terrified of gravity. Okay.
It's true, though. When you print a 75% gross margin and then guide for roughly 81% next quarter, the market immediately thinks this has to be the peak. I mean, memory is cyclical. Plus, management signaled massive future capital expenditures. We're talking over $25 billion. Wall Street always gets extremely jittery when they see peak pricing power paired with huge new factory spending.
Peak cycle anxiety, right. But then you hear management talk about demand outside of the data center, and it sounds almost like science fiction. Like they mention a level 4 self-driving car needs 300 gigabytes of memory internally just to function on the street. And that paves the way for humanoid robotics. The physical world is just becoming this giant memory sink.
Well, it is. Intelligence requires state, and state requires memory. The more autonomous the hardware gets, the more DRAM it burns through. And they're literally building empty clean rooms just to have enough floor space for future machines. It's a structural shift, not just a server cycle.
All right, let's get into the details on how they're actually securing that future demand.
Yeah, so this is actually the part that fundamentally changes their story. Historically, memory is a pure commodity business. You do these 12-month handshake deals, the long-term agreements, and when the cycle busts, buyers just walk away or renegotiate.
Right, they just default to whatever the spot price is doing.
Exactly. But now, because everyone is absolutely panicked about HBM supply, Micron is forcing them into these 5-year strategic customer agreements, SCAs. 5 years. I mean, in the semiconductor world, 5 years is essentially a geologic era.
You were basically signing a mortgage for silicone. But wait, 5 years in tech, how ironclad are these things? Because if the AI build-out hits a wall in, say, 2027, are Apple or Dell really going to honor a contract at peak 2026 pricing?
That is exactly the question. And the analysts tried to nail Sanjay down on this twice during the Q&A. They wanted to know about cancellation penalties or price floors, and he aggressively dodged it both times. He just kept repeating they have, quote, specific commitments.
Oh, wow. Okay, so maybe not as bulletproof as Wall Street wants them to be.
Probably not, but it is still a massive shift. They are extracting, I guess you would call it structural stability that they have literally never had. And Sanjay actually framed this perfectly on the call. He said, and this is a direct quote, AI hasn't just increased demand for memory, it has fundamentally recast memory as a defining strategic asset in the AI era.
Recast as a strategic asset. That is a heavy pivot for a memory supplier.
It is, although there is a catch to all the stability. And it ties back to the $25 billion in CapEx we mentioned earlier.
Right, because spending $25 billion sounds like you're buying out every lithography tool on the planet to build ships tomorrow.
You would think so, but it is actually no. Most of this money is just for pouring concrete. They're building empty shells.
Wait, pouring concrete? Just physical factories without the machines?
Yeah, they talked about buying the Tonglo site in Taiwan, doing major ground prep in Idaho. They are building out massive spaces for machines they have not even ordered yet.
Hold on. If they are so capacity constrained right now, why spend billions on empty rooms? Why not buy the actual production tools?
Because high bandwidth memory, the HBM going into NVIDIA servers, it uses an absurd amount of wafer die. And the packaging requires drastically more physical floor space than traditional DRAM. You cannot just cram more equipment into existing factories. They literally need gigantic new buildings just to physically house the process.
Okay, so the physical footprint of the manufacturing is inflating just as fast as the demand.
Precisely, and that is a huge long-term risk. They are spending heavily on structural footprint, not immediate revenue generation. If the GPU market saturates in a couple years, those empty shells are going to be a brutal drag on free cash flow.
Talk about a high wire act. I mean, you even had Sanjay pause the call, right? He stopped the proceedings completely unprompted just to correct a tiny slip of the tongue. He accidentally said they would reach HBM market share parity in 2026, and he stopped everything to clarify he meant 2025.
Yeah, which just shows you how hypersensitive management is to the narrative right now. Wall Street is tracking their HBM progress to the exact quarter. The market is pricing them for guaranteed perfection.
But perfection is so fragile when margins get this high. If they are guiding for 81% gross margins next quarter, at a certain point, memory gets so incredibly expensive that chip architects are going to start finding workarounds, right? They'll figure out ways to use less memory just to lower the bill of materials.
Yes, exactly. High prices cure high prices. If memory takes up too much of the server budget, the hardware designers will absolutely start optimizing away from it. It takes time, but that 81% margin is basically painting a massive target on their own backs.
It's almost like they're daring the industry to engineer around them. So where does this actually leave their trajectory heading into the rest of the year? Are they a fundamentally different company now, or just riding the biggest wave in hardware history?
I think it is, probably both. You do not ride a wave this massive without it fundamentally altering your structure. But regarding their trajectory, look at the guidance they are projecting for next quarter.
Right, that crazy 81% gross margin target.
Yes, along with $33.5 billion in Q3 revenue. And Sanjay actually pointed out on the call that this single quarter revenue guidance exceeds the full year revenue for every year in their history through 2024.
Okay, that is... My brain actually struggles to process that. One single quarter wiping out entire historical years. It almost feels like they broke the math.
They definitely stretched it. But here's the real unknown I'm tracking now. Management casually warned that PC and smartphone shipments might drop. I think he said low double digits next year simply because of this memory shortage.
Right, the whole crowding out consumer risk. The device makers either can't afford the components or they just can't find them.
Exactly. It is actually a much bigger problem than just Micron's margins. We have to wonder if the broader tech economy can even handle the weight of these AI server ambitions. If this build-out literally cannibalizes the phones and laptops in our hands, that becomes a systemic macro risk.
It absolutely does. The entire supply chain is holding its breath. So I guess the big test going forward is whether Micron can perfectly execute that 2025 HBM rollout. You know, making sure those massive empty cleanrooms don't turn into financial deadweight if demand slightly cools.
That is the central tension. They are running the operational engine at absolute redline right now. It's beautiful execution, but any friction from here is going to leave a serious mark.
Well, gravity always collects its debts eventually, Miro, even for hardware companies. But honestly, what an incredible spectacle of a quarter to witness.
Let's just see if those shiny 5-year contracts actually hold up when buyers finally blink.
Oh, you know we will be waiting right here to check the receipts. All right, I think that does it for our analysis today. Let's send it over for the wrap-up.
If you want these earnings drops to just automatically show up for you, go ahead and follow the show. And just a quick heads up, we are experimenting here. So this episode was actually generated with the help of AI tools to shape those heavy SEC filings into a real conversation. We'd absolutely love your feedback or, your ticker requests. So shoot us an email at earningsunscripted@datamadness.ca or just find the X link in the show notes. Thanks for hanging out, everybody.
See you next time.